Hey, monkey head, turn the mic on, eh? Oh, for sure. Hey, it's Monday, March 26, 2018. This is your daily Forex trading strategies session brought to you by Forex.Today, hosted by Forex.Today. Thank you for coming to Forex.Today. Let me remind you that trading Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Joe wants to know what kind of guitar I have. I don't know. Eric Clapton gave it to me, and he's like, hey, my friend, thank you for everything. I'd like to give you this gift. I'm like, whatever. Sure, Eric, great. I'll take your trash. It's fine. So I don't know. I don't know what it is. Hey, my name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. Thank you very much for being a client. Throw your diamonds in the sky. Do these sessions for you Monday through Friday here at Forex.Today at 7:30 in the morning. That's a couple hours before the New York stock market opens. It's also approximately London lunch. Great opportunity for us to gather as a community here at Forex.Today. Now, as the Chief FX Market Strategist, I have been charged with the duties of helping you become a success sooner than later. We want you to at first survive and then thrive as a currency trader because it's in our best interest. We would like to be the broker for your successful Forex trading business. Yeah, is that right, Chuck? Yeah, you got 5? Yeah, I said to him, I'm like, well, thank goodness you don't play piano. That's all I'm saying. So good morning, everybody. It's really good to see you. Let me fire up my charts. Boom, sharing my screen. Ba 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 ba. It's almost there. It's almost there. He's almost there. He's almost there. All right. What's up, Calvin? Okay. Dive into it. Let's get going. Let's start on the Aussie D. Never hit our target last week, or I suppose really for the month. So if you are a bear, you listening to me? If you are a bear on this, you still have a few days to get down to target. Okay? Let me make this blue so you don't have to use special eyewear or something. Okay? Let me redraw that a little better. Check this out. I would imagine that somewhere in Heresville, if you are a bear, you're setting this up for a short. So you got to create your sell zone, okay? And your monthly target would be down into here. So let's drop into a smaller time frame, only a 4-hour. Let me back up. Oh, we were over here. Hang on. Back up and try to squeeze that in there. So your thought process from the little x. Remember this study, the little x to the big X. All right. So your thought process here. Well, no, let me get rid of that because it's not accurate anymore. Okay, there to there to there is what you're trying to do for the month of March. Okay, that's what the month of March is all about. Now, what if you're a bear and you're trying to fold in your weekly inside your monthly strategy? Well, for that, we're going to have to use a smaller time frame. And my spidey senses tell me, that was supposed to be red, by the way. There we go. This is the weekly trade plan for a bear. The blue one is the monthly plan. Very interesting, isn't it? If you're a bear, that's what you're thinking. I don't think you could think anything else. That's a monthly swing with a weekly swing. And that's that. So if you're a bear, that's what you do. Okay? Roger? Cool. Now what if you're a bullseye? A bullseye. If you're a bullseye, you should have bought it at the open. We probably talked about this on Friday, even though it hadn't happened yet. Our supposition, our supposing, our general trade plan, if you were a bull, that this was acting as support and that this was sort of the Monday trade plan, the next week trade plan. I don't know if we talked about that on this particular pair, but it's there. Okay. So more trade war stuff is going to bring this down. Remember talking about the Kudlow effect? Dollar strong. I'm a US dollar bear, but things may change. I'm very open-minded. Okay, because of trade barriers will increase the value of the dollar. And if you've forgotten why, a week or 2 or 3 weeks ago, I gave an example of going to Home Depot and buying a wheelbarrow. And you're like, hey, Mr. Home Depot, why is this wheelbarrow $259? It was like $89 last year. What's the deal? He's, well, it's American made with American steel, with American workers. And you're like, well, I only want to spend $89. Well, it didn't come from China. Look at that, huh? Isn't this pretty? Well, Devista, what would you expect? There you go. Well said, sir. Well said. All right. So, yeah, I would guess that too. Well, okay, you guys are talking, there's questions here about, well, didn't this happen and didn't that happen? When wouldn't higher prices slow down growth? There is something in economics called long run and short run. Okay. So, for example, if the steel tariffs go into effect, and you walk to Home Depot, have prices tripled? If the economy slows down significantly, does your boss come into your office on the first day and say, I'd like you to work for 30% less salary? On the first day, like there's a GDP announcement. Oh, we're at less than 2.0, and they walk in like, you're going to have to work for less, right? So they call that prices are sticky. Okay, so let's see. Thanks for allowing me time to build a complete economics course ahead of time. All right, let's try to do this. Demand and supply. How should we do this? I guess what we should say is if this curve shifted here, okay, and this was let's say this is long term. Oops. This is, let's say, the normal economy at full employment, full productivity. This is output on the long run. And then for some reason something happens and the economy moves over here. What'll happen is it'll raise prices. This is price and quantity, right? Right? So for some reason the economy is overheating. We're producing, there's more demand for products than what there should be on the long run. And again, long run is what the economy should be producing with normal, let's say with everybody working in all factories at 100%, right? That's the maximum in normal healthy conditions that the economy should be producing, but all of a sudden there's cheap money and you're building like ghost cities and all this kind of stuff, right? You're producing more than what the long run equilibrium, maximum productivity of the economy should be, right? So anyways, so this shifts out, right? And you go from P1 to P2, okay? And you go from Q1 to Q2, okay? That's short run, right? Whatever you define short, that's just short run. For some reason, there's more demand, so we're producing more, but it might be cheap money, building ghost cities if you want to think about that. So think about it like in China's case, it's building steel nobody needs, it's building cities that nobody lives in, but it's building something. So that's outside the normal capacity of their full productivity of a normal economy, right? What they're doing is sort of abnormal, right? So what eventually happens? Well, prices go up. What happens when prices go up? Okay. Oops. Well, what I meant was this. And eventually, right, you get here. What are you left with? Quantity goes back down to equilibrium price. But what actually is that happens? You end up going back to the long run productivity of the economy, but at higher prices. Okay, so you're back to Y bar. So you got like short run, which is Y, right? So we can even call this Y, just call that output. And then it falls back to here, and then we're back to Y bar. Does that make sense? So you're asking me things like short run, long run, and all this kind of stuff. Well, take some time. Yeah, but it's not instant. So in a simple economics model, you're talking long run. Right? So again, here's a simple economics model if you're doing money supply, all right, which is typical macroeconomics. And I'll change colors. Okay. What kind of slope does this is price? I guess what kind of slope does money supply have if there was $1 trillion worth of money? At this equilibrium. Thank you, Craig. Vertical, because it has nothing to do with demand, and that's not a P, that's a D, by the way, demand 1. See, it doesn't matter the price. If you have $1 trillion in the economy, it doesn't. If prices are high, you still have $1 trillion. If prices are low, you still have $1 trillion, right? So you have this. That's a typical standard money supply, money market, macroeconomic model. And so if demand is low, you can increase demand by increasing the money supply, and you can shift this way. Okay, increase the amount of money, and that's going to increase you from demand and all that kind of stuff, right? All right, whatever. But that's very long run. So you're going to have two charts and two time frames, and it's very similar to trading if you think about it. What if all you did was look at the 1 minute and 5 minute chart? Okay? Versus what if you only looked at the daily and the weekly? Okay? So you're going to have to look at both to understand where you've been and where you're going, right? Anyways. All right, so check this out. This is very interesting. This was our sell 2 weeks ago, I guess it was. Monday's sell, maybe. So anyways, it's worked its way down, and now we're kind of bouncy. So you need to decide as a technician now whether this is, you know, an old man easing into a hot bath. Okay. Get out of your own way. Okay. I just want to check that. If you were a bull, your plan Monday morning was something like this. Okay, and if you're a bear, your trade plan Monday morning, and you're like, Wayne, it's Monday morning now. No, Monday morning, when the market opened, right? You were thinking this. So then you're going to look at this little top, and you're like, man, oh man, this is the place I'm going to bomb it. I'm going to, right? That's your first price as a bear now. And your second price is going to be sell the hell of it around 130. You get it? Bulls only have one plan at the moment, and it's this. I guess I should change colors, right? So the red squiggly line is the only plan a bull would have today. That's it. I don't see another one on this. Okay, that's it. Enough said. If you're a bull, that's the only trade plan I see on this chart. And if you're a bear, there are two, here and here. And that's where I guess I have to draw it, right? You're thinking about selling it here or here, either way, right? This one's based on price action central pivot. This one is based on psych level and M3. Okay. You know what I'm talking about? See, it gets really simple if you have a trade plan. If you're reacting to things, you've already lost. If you're a bear on that and you're like, well, it's got to go up to this other level or even further, and those are the two prices I'm thinking about selling. It might be today, might be tomorrow. What's the big deal? Right? The big deal is when you're opening your charts and you're trying to find a trade. Oh, what should I do with this? I should buy it. I should sell it. You're like, whoa. Okay. So now what? This is way out of position for a bear. Bull, this is very difficult to buy. Sorry. This one's a doozy, guys. I don't know if you can do it. This might have been the one actually. You know what? This might have been the one on Friday to say if you happen to be a bull, that's why I have this set up. Can anyone confirm that? I mean, I'm not 100% on that, but you can see we have it sloping up. So I can see we're talking about a reversal. I can see we're talking about a wedge and then the wedge breakout. And then I can see we would have assumed in here the long and a target here. Does anyone actually remember? I admit I don't quite remember. I can just see the chart. I can see we're talking up, and I can see the prices where we were. But did anyone actually like put it together, part of their plan? Yeah, okay. Okay, good. All right, so I did do it. All right, cool. Boom. Nice. And you can see that you're going to need to take profit later today. That's the sad thing, because you're so right so quickly, and you just want to be on this forever because you're so right. It's just going to go up forever, and maybe it does go up forever. But on a weekly basis, if you get here too quickly, the counter trend trade says you come back here, and you're going to be back to the bottom of the channel. So I think if I were me, if it was up here today or tomorrow, I'd book my profit, see what happens, and maybe buy a dip into here if it happens to go back up. But even then, I might be wary. Then we get into the law of averages scenario. You're like, well, what if it just keeps going up without me? Well, dude, you got the full Monty on a weekly swing. What more do you need, right? You just get ready for the next trade. The monthly swing, by the way, you recall this one? The monthly swing was on the first day of the month here. Remember that? And the target is here. Well, we're not going to get there today, are we? Or this week? Are we going to get there this week? I mean, like, really? I mean, we could have a monster. Well, but see, it's this week, this month, right? This is the last week of the month. So to hit our target, we got to be there this week, right? So what would that look like? Well, I think, and I'll change colors just to make it more obvious. I think it would have to, let's say, we hit here, we pulled back, and I mean, something like that. We just have to have monster weakness, which is very good news, remember. I think that would be incredibly good news. And check this out. Get out of your own way. Right? I mean, it almost seems like it'll be, if it's so aggressive, maybe it even does this, which would be even more aggressive, using this and the pivot and the profit zone. I don't know. You're going to have to be quite bullish. Look, I think if you snuck that out, you just have to say on the long run to take your profit in the pink zone there. It's just what you do. You did your job well, so on and so forth. You couldn't. That's why I started with that. You're out of position. You're too late. It's way overbought. You're at a resistance zone. If you do something now, you just. I mean, this is why I talked about it on Friday. Right? I mean, that's it, right? You're like, well, how do I get on Friday's trade plan now? I'm like, you can't. So I'm trying to teach you what we discussed on Friday and why it was important. And you probably thought I was, a monkey head back on Friday. You're like, this ain't going up, Wayne. Okay. See, I see the monthly. I see the old man. This is the old man conversation. The old man needs in a hot bath. So I see the old man in there. I see the pivot. I see the weekly swing on Friday. Right? Give this as he got out at M3. That's not a bold move. That's not a bold move. It's a very, I mean, you can argue like you were at resistance and all that, but if you were to have entered here, you have to say to yourself, I'm in a swing trade, and that's the target's up here. And based on that analysis, you should blow through that M3. M3 is only for bears. So if you're a bull, I mean, the only thing to say is if it collapses at M3, you got to manage your risk. So I'd rather you like move your stop at M3 than take profit, because you're in a bullish swing trade and then you bailed. I'd rather you break even than bail on a profitable trade that's that's doing its thing, right? Never. I'd rather you have a break-even loss kind of thing than a small win. Yeah. Okay. Cool. I can see it. I see the resistance, but what it tells me is you were not confident in your plan to begin with. So in that case, I'd rather you just manage the risk than take profit. Okay. Yeah. And and maybe, in situations like this, I used to do things like, I'd take the screenshot when I made the trade, and then I'd print it out, and then with a marker, I would draw it and say, that is the plan. Okay? You can't be in the situation where you're biting your fingernails. I'm up 30 pips. Should I take 30 pips? And then you start saying to yourself, well, you can't get poor taking profit. Yeah, but you'll never get rich either, right? So what do you want to be, not poor or rich? Not poor people dig ditches, right? Technically, you're not poor if you're flipping burgers at McDonald's. Well, yeah. So, anyways, I was listening to an interview with a man who is, I think, like a senior strategist at Lazard on Wall Street. He was a street sweeper. Isn't that interesting? Street sweeper. And then he got a better job. He worked at a lumber mill. And then he's like, I gotta do something about where I'm going. How's that song go? You gotta walk. You got to talk without speaking. Scream without raising your voice. Yeah, I don't know what song. Anyways, yeah, he was a street sweeper. Then he worked in a lumber mill. And then he's like, you know what? I gotta do something about where I'm going. Now he's got like, I don't know, $50 to $100 million in the bank. He's a senior strategist at Lazard. And he's like, this is so much better. He just wanted to be in an office. But, or Joseph Trezevani was a New York City taxi cab driver. That kind of stuff I think is pretty interesting. Then he's like, I should be in finance. And all of a sudden he's living in Bermuda. He's one of 5 currency traders in all of Bermuda. Right? Kind of neat, right? So anyways, maybe you're in the next story, right? But anyways, yeah. How do you catch last week's trade plan today? You can't, bro. And then let it run, and then take profit when you should. Okay? Because again, the counter trend trade is going to exist. If you hit this today or tomorrow, the counter trend trade sets up. So you might as well just, the law of averages, I covered that in great detail last week or the week before, dictates on the long run, on Y bar, you should just take your money and run. And it doesn't make you more money. It doesn't make you less money. It just gives you more time and less stress. Maybe you find a better trade to be on. On the long run, you'll do better. Enough said, enough said. Cool. WTI. How are we feeling about this one now? Do you remember Crazy Wayne, Crazy Uncle Wayne? Crazy Uncle Wayne says at the beginning of the month, and that Canadian dollar was so unbelievably weak, so we're like, hey, well, I'm more bullish than bearish on oil, and we're quite close to the monthly swing long. Who knows? And I'm sure this was a weekly, right? So this was 4 weeks ago now, 3 weeks. Yeah, we're in the 4th week now. So I'm just like, well, fundamentally speaking, I'm more bullish than bearish, right? We talked about fundamentals, nothing technical on this. We're in a buy zone. And what was our target? Way up here, right? 67. Right? Now look where we are, danger zone, right? Now you want to wake up and buy this, right? We spent a good amount of time talking about this, didn't we? Because I remember I was talking about its correlation to CAD, and there was nothing on the USD CAD that would say Canadian dollar was going to get strong, except it was at what, the monthly target, which suggested USD CAD should fall, which suggested Canadian dollar had room to grow, and then oil was at a buy zone. So if we can get oil to go up, the USD CAD was going to go down because it wasn't supposed to technically go up any further, which means Canadian dollar weakness, right? USD CAD. So if USD CAD couldn't go up or shouldn't go up any further on a monthly basis, then that would mean oil should go up. And you're like, oh, look, technically speaking, oil's in a buy zone. And sure enough, USD CAD dropped and oil did go up, right? Did anyone gather a lesson from that? Maybe the routine of intermarket analysis and commodity currency correlation and such? I think we must have spent at least 20 minutes on that, maybe more. Right? I'll put it back. It started with this. This wasn't supposed to go up any further, and we were still in this area. We were still like this. So I'm like, well, it's not supposed to go up any further. It's supposed to lower low, lower high, lower low, lower high, lower low. Look, I wasn't that accurate. Okay? So what about this? If this bottoms out, it means either the US dollar is getting strong or maybe CAD is hit its limit, which means maybe oil hit its limit. Well, you got to be careful. Kind of like a leading indicator. No, it could be a lagging indicator. They're just related. Okay? Somewhere between -1 and 1, there's a relationship. Okay? In this case, the relationship between oil and USD CAD is typically somewhere to the left. Okay? And if you looked at it like a bell curve, you might expect something like this. This would create a fat tail. I think it'd be more like this, meaning that this would be more typically closer to -1 than 0. Okay? That's a fat tail. if you're analyzing someone's trade history, you don't want fat tails because it means they take a lot of big losses, but they also have a lot of big wins, and there's not much in the middle. That's not cool, right? That's high volatility. As a trader, you want to see this. You want small tails. And the vast majority of trades are small winners, or sorry, small losers, small winners, and all that kind of stuff. And this tail maybe is slightly bigger than this tail. So this is where you do well. These two wash each other out, and you never have any big losses. Just, I don't know how your statistics background is. But if you were investing, that's what you'd look for, wouldn't you? What would you do? Seriously, let's say you had $1 million. Would you want to invest into someone that has big losses and big wins? No, but everyone talks about that though, right? Oh, wow, but I had this huge month. Well, if reward is a function of risk, then you took big risk, which means you're setting yourself up for a big loss, and people don't want that. So you got to look at you got to look at the beta too, right? So you say, well, the stock market was also, something was announced, quantitative easing was announced, and the stock market rallied 10%. That's why I did really well. Well, okay, great. So your returns are not a function of risk; it's a function of the beta. Your alpha had high returns because the beta had high returns, and everyone would understand that. In reverse, too, if the stock market plunged 40% and you had a losing month, you could say, wow, do you remember that day when everyone lost 40%? Well, I only lost 10%. And you're like, oh, well, that makes sense. That's really understandable. But, because it's correlated to the beta, right? But people want low volatility and they want risk-adjusted performance. So if the market did nothing and you're up 10%, the only way you could do it is take on risk, and nobody wants the risk. That's why they hired you. They're trying to get away from risk. No, Calvin, it doesn't. It says depends individually on the risk appetite. No. I'll tell you why, because you're going to put yourself in a situation where they will lose, if not one day, the next day. And that's going to be a problem for you. They'll tell you, oh, we want more risk, we want more returns, go for it, go big, go do this, and then they will screw you over. Trust me. Then there'll be so much crying and complaining, and you're like, dude, I told you. No, you will get royally screwed. So you got to take it the other, and you're like, no. Because the person that says these things like, no, I want you to take more risk, I want you to go big, they don't understand what they're talking about. It's just a huge red flag. You're like, oh my God, I can't take money from you. You have no idea what you're talking about. Okay? Seriously. Trust me on that one. Don't learn the hard way. All right. So if USD CAD goes up, that means oil down. So in that case, you're going to want to be careful of this top. Okay? Okay? That's not typically, that's a holding point for oil, but that's not typically it. But if oil falls there, I would expect this to be the bottom. Okay? And that means we're in a long-term range between 65 and 57. Basically 65, 55, right? So what happens here, if this rolls over, you're basically long-term neutral and you're just trading a range. If you're a bull and it rolls over here, I think what I would do is I would buy it around 63, and I'm going to take it up to 70. Well, not 70. I'm exaggerating. 69 and a half. But you know me. Get out of your own way. 8:15. Cool, we got time. I would like to venture over to Forex.Today. Oh, for Sherry. Yeah, inventories peak out around June. Calvin. Beautiful. What a beautiful website. Beautiful trade planning, Brooke. Joe, Pedro. Beautiful. Cool. Well, yeah, Calvin, if you don't know, then now you're going to need to spend time researching, which is a huge opportunity. I'm not bailing on this, but if I tell you inventories tend to peak out in June, and you're like, well, what does that mean? You just uncovered something you need to know. I mean, I could tell you, but why take the learning experience away from you? I guess that'll be all right. Well, let's do high impact first. Okay. So, for example, like, why am I a fairly decent trader? I'd say, well, I did things like look at 50 years of inventory data produced by the IEA. I mean, how long did that take me? And sit and think about it and look at the research and read it and all this kind of stuff, and then put that into my trade planning and see, well, how did that affect oil markets over the last 50 years, and how does that affect the Canadian dollar? It's not that somebody told me. You understand that? Like, it's not somebody told me. The person that got me the data was Kurt Worley. So I said to Kurt, hey, Kurt, you have a master's degree in applied statistics. You're really good with big data. I wonder if you can do some quant duties for me. I'd like you to go to the EIA or the IEA and see if you can download historic data on oil inventories. And then, you know, we should probably cross-reference that with market prices and maybe the Canadian dollar. And off he went and he did it. And then we looked at it, and we thought about it, and we talked about it. And all of a sudden, I'm like, oh, well, there's a relationship here. And all of a sudden, it was my alpha and Kurt's alpha. We knew this. And it wasn't an opinion. It wasn't something we read in someone else's book. Right? Right? So like I'm reading a book like, well, Kathleen says it should go up, so I'm going to teach that to everybody. No, well, you got to do the work. So, yeah, so that's where we got the data. I don't know anyone else's opinion. It's weird, but that's why I'm not interested in anyone else's opinion. So I'm pushing you in the right direction. Okay, Calvin? Yeah, I'm just pushing in the right direction. Oil inventories tend to peak out in June. What does that mean to you? Yeah. Because one day you'll have to sit down. Again, this is your big shot to get $1 million from a client. You got to sit down. And you're not going to read from a script, are you? You're just going to talk markets. And they're like, well, how about oil? And you're like, oh, how about oil? Here's an interesting thing about where we are now. If you look at the current price versus historic price and look at the correlation with inventories and what the IEA and the EIA say over the next medium and long term run, there's something very interesting. And you start talking. They're like, wow, this Calvin guy is off the hook. Boom, Calvin. He's hot. Here's my money. Yeah. So that's why you need to do the work yourself. Because you want to put yourself in that situation. Like, how do you know this? You're like, well, my quant and I got a hold of 50 years worth of inventory data and cross-referenced that with futures prices, but also the value of the Canadian dollar over that same period. Yeah. We're that good. We're that good. Yeah. Maybe even better. Cool. Right? All right, so we got some speeches today, blah, 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 blah. Nothing's going to happen. Great, great, great. What a great day. And then tomorrow, nothing's going to happen. But this might be all right. I mean, there's always Trump. I mean, how many porn stars are going to start showing up now, huh? Right? I mean, seriously, I'm telling you, what, he only had sex with one porn star in his whole life? Look, right? There's just no way that would happen. Yeah, I'm famous. I'm unbelievably wealthy. I just got to get this off my bucket list. Just once, I'm going to fold to temptation. But just the one time. But after folding to temptation, then I'm going back to being disciplined. I mean, like, right? Like, what happens when you pick the apple off the tree? You just like, damn, these apples are amazing, right? You just find yourself on the other side of the fence, that's all. Yeah. But there's no way that was that one time. This is why you should never go to Vegas. Because you never know. You're running for governor. And you've been awesome your whole life, except that one time in Vegas in 2006. And you're like, I just got messed up. I didn't know what was going on. I was young, though, too, and there was things going on in my life. I was in a weird place. It was a weird weekend, man. Right? And they're like, you can't be governor anymore. You're like, what? Right? I've lived such a strong, powerful life. I'm trying to change the world, make it a better place. I made one mistake. You're like, well, you can't work in the U.S. government. You know how perfect the people are in our U.S. government, right? So anyways, so then zip along. Okay, GDP, cool, right on. GDP, we want to see where we are. It's very, it's very a long time ago. It happened it's very backward looking. Pending home sales. The pending home sales suddenly are interesting again because prices are so high in the United States that houses are not selling. And it's an inventory issue. It's interesting. So the the curve, we're moving along the curve and shifting the curve perhaps. So that's kind of interesting. Retail sales out of Japan. Sure, why not? Your German unemployment, UK GDP. Now, then we have this PCE stuff on, I guess it's Thursday. Yeah, it's interesting because the Fed uses this deal. No, it's too early for the peso. I know the peso is strong today, but it's too early. So don't drink the Kool-Aid yet. It might be fool's gold. Okay? You're like, oh, look at this gold. Shah, that's fool's gold. We're not to the quarry yet. Just relax. Right? All right, so cool. So PCE on Thursday. PCE is something that the Fed uses, so it's fairly important, right? CAD GDP, obviously that's going to move CAD. Thursday in Asia, which is Friday for Asians, those in Asia. Right? So anyway, the unemployment rate, what is it, 2.1, 2.3? I mean, amazing. Non-manufacturing Chinese data. Well, we kind of care about manufacturing Chinese data, right? Then Friday, Baker Hughes is basically the only thing. I mean, European CPI. Oh, fine. Okay, fine. And then really the Sunday stuff. I think there's more Chinese data than this, isn't there? Anyways, we got this one, which is a good PMI out of China, and then this Tankan survey is also pretty good. So that's a pretty good way to start the week. Okay. So it's a moderately quiet week. There's some GDP and stuff, but like I said, GDP is backward looking. We're talking about last quarter, not now, kind of thing. So it's important, especially on long run equilibrium or a lot. Yeah, if you're investing, I think it's important. If imagine you were a currency trader and you thought quarter by quarter, it can be done, right? How many times have I told you you're like, yeah, this currency is going to get strong for the next 3-4 months, and then it's going to get weak for the next 3, 4, 5, 6 months. I mean, a lot, right? So maybe you trade that way. Maybe you're more of an investor, which would be more of a position holder, more of a carry trader. Then you'd be looking to set those things up, right? So, for example, in the next month, imagine you thought this way. In the next 4 weeks, you assume that the yen pairs are going to go up. So then you're going to look at these GDP numbers. You're going to look at the Tankan survey, the Chinese data, because you're looking for bigger moves on like commodities, money flow, that kind of stuff, right? Now I'll remind you that the first foreign exchange hedge fund, FX Concepts, back in the 60s or early 70s, they made an amazing amount of money focused on longer term like that, and they didn't make any pips. They only made carry. And John Taylor, the guy that started the company, paid himself $125 million a year for like year after year after year after year after year after year after year. You're like, yeah, right? Yeah, for years. And his firm basically didn't make any pips. He hedged everybody and collected the yield. All right, so I got an indirect, nonviolent protest question on high yields. We'll zip over there. Okay, we'll do some high yield. All right. Right? USD try. I'm looking at the monthly chart. Does that look like a double top to you? It's monthly now. That's way out there. So you have to have that in the back of your mind. What about 4.0? Do you think that's going to be an issue? It could. I wouldn't say it should, but it certainly could. So let me change this template up. Let's go back to something more believable. Okay. So the 4.0 you would think would be a problem, would be respected, right? So let's move beyond that. Does that look bearish to you? No. No, it does not. Okay. But if you had to be a bear, this week, you had to. Maybe you're the USD Turkish Lira ultra short portfolio manager. By the way, I'm going to launch that. So the technical people still like, we can't figure out why it won't do it. So anyway, so I'll work out something, but I need to get you guys on board on that. But nonetheless, if you were the USD Turkish Lira ultra short fund portfolio manager, you can only sell it. You're going to try to sell it around here. Okay, you got the M3, the WM3, and you have the psych level 4.0. Okay, so on the smaller time frames, you're going to want to witness something like this. Okay, so that's the trade plan. So now you know your price, right? So we got to kill that. Now you got to drop into here, and you got to start looking at this. And does that look like it's rolling over? No, it does not. Okay. It's heading up from a buy zone. This is your weekly buy zone. Okay. And it seems to be riding the 21. And it seems to be kicking off the 200. So it looks like a reset is what I'd call this. And that's what this would do, technically speaking. Now, we don't know. The psych level is the issue in here, right? So what you want to look for is, and ideally up here, is something that is unexpected on a bullish area. And that would be the lower high off the psych level. Nice music. What do you mean nice music? In Turkey? Or am I singing again? Half the time I don't even realize I'm singing. Sorry. Okay, so anyways, I would look for something like that before I really get involved. Okay, so be smart about it. You don't have to be the first one in on this. I don't have background music, Barry. No, I have background music. Oh, the construction. Yeah, sorry, I'm building a wine cellar and a soundproof movie theater. Sorry, I didn't know. We're at the monthly R3. And I would say, what are you talking about? Hang on. So, yeah, so you're saying we're at monthly R3. Let me tell you Actually, no, Amelia, we had that designed, but I ended up not doing it. So, because there was going to be like a small seating area, and I wanted 4 people, and it would only hold like 3. And then I'm like, yeah, it's too small. So then I decided to make a storage space behind that. So anyways, so R3, Katie says it's R3. First of all, I don't see that as R3, so I don't know your calculations. My R3 is down there. But let's nonetheless, I don't know what R3 is. Yeah, Emilio, I did, but then you don't want to talk your wife into anything. Anyways, I don't know. Here's the thing. I don't know what R3 is, Katie. When was the last time I taught somebody about R3? Is R3 in my book? I don't think so. Is it in the training course? I don't think so. Like the swing trading course? I don't think I talk about R3. So it might be a personal limitation, and I fully accept that, but I don't know what R3 means to anybody. So like, I'll tell you, on a daily basis, I came up with something called a moo trade. So imagine these are like 5-minute candles, and this was daily pivots, the big pivots. I said in a situation where you find yourself way above the pivot profit zone, which is here, you keep buying until the cows come home. And of course, the cows come home at the end of the day, right? So somebody asked me, well, what do you do in that situation? You just keep buying, right? In this case, we're just sort of now approaching the end of the day. In this case, it's not a day, it's a month. So I don't know if that makes sense on a monthly basis. I don't know if it makes sense on a weekly basis, but 15 years ago, I came up with that little moo trade idea. But if that's the case, if I'm above the pivot profit zone and I'm buying still, then I'm not respecting R3, right? I'm buying until the end of the day, so now I'm buying until the end of the month. If that same rule was applied, then I'm not respecting the R3. But because I don't know if a moo trade applies to monthly pivots, I wouldn't recommend that either. So it's just, that's how I got here is all I'm explaining, right? Where it's just so unusual to be at an R3 or an S3 that I don't really have a ton of experience trading at levels that are unusual. And if it's so unbelievably bullish that we're at R3, I don't know if I want to sell something that's unbelievably bullish. You see what I mean? If everyone was supposed to take profit here, okay, and then go back to like I'm training you, right? How many times do I ask you, in your opinion, do professional traders use monthly pivot points? And everybody says, yes, Wayne, yes, everyone uses monthly pivot points. Okay, great. So we understand that. Great. Well, they didn't get out of these monthly pivots, and every institutional investor uses them. So what did we learn? That the dollar's ripper strong or the Turkish lira is ripper weak, and every professional investor on the planet knows. So do I want to sell at R3? I'm like, if they didn't get out at R2, why would they suddenly want to get out at R3? So you got to go beyond the lines and say, well, R2, R3, they're all the same thing. And you always have to ask yourself, how do professional investors interpret these lines? This was the obvious long. This was the obvious get out, but we blew through that, so obviously it's unbelievably bullish. And, I think the only thing that wicked this out is there was a lot of limit orders at 4.0. So I can also tell you that there are a lot less limit orders here at 4.0. So maybe that's the beginning of a turn. But do you really want to sell a market knowing that every professional investor on the planet, institutional investor on the planet, was long this thing? Yeah, well, at least be careful, right? So I think you could, keep your eyes open around 4.0. And here's the cool thing. You ready? It's next month's sell zone. So do you want to sell it now, a week early? Well, you could set it up. You could wait for it and prepare for it. But if this did turn and you were short at like 3.9998888777666, you might as well stay short. If you can stay short for the entire month of April. And then you get yourself in your situation where, well, if macroeconomics takes off the way that you think, you might be short USD Turkish lira all April, all of May, and half of June. If that's true, then you certainly have time to set this up properly. Okay? And my opinion is this Turkish lira is not going to get strong until Europeans are confident. Because Americans don't invest in Turkey. They don't even know what Turkey is. They don't know where Turkey is. They laugh. They're like, Turkey? Like it's Turkey. Turkey. Like, dude. Yeah, like the bird. You're like, are you mentally retarded? But I'm just telling you, I mean, this is the American response. I don't know anything about Turkey. Okay, great. What about Europe? Well, Europe sees Turkey a lot different than the United States, doesn't it? And it's a place to deploy capital when everything in Europe is overbought. You see what I mean? And Europeans will look at it as an investment opportunity. So when we get to the point where the Europeans feel confident in their economy, and hedge funds in particular are going to start tiptoeing into Turkey, is my opinion. And then when Europe is fully overpriced, then it'll probably snowball. It won't be more. It'll be more than a tiptoe into Turkey, right? There'll be a lot of money flying towards Turkey. So in that case, the Turkish lira should improve. But I don't think it won't improve until you really get Europe on board. Because I think the money is going to come from Europe more than American hedge funds, simply because they don't know. Okay? So there's that thought process. I don't know if you want to be the first one in on that. But if you do take that risk, you better stay in it for the long run so you can get paid for the risk you took. You took it. Okay. So I'm looking at this. This is all to sell on Friday, but I don't know if you wanted it on Friday. So I don't want to talk about peso. You should already know. If you know, if you don't know, I'm not going to tell you. ZAR is tricky. We are in a tight range, and by tight range, we've gone from M3 to M2. So that's interesting. And if it bounces here, then we're going to go back to M3. I do remember covering this in somewhat detail last week and the week before. So I remember on Monday, the first Monday of the month, we were talking about dropping this. And that was before all the trade barrier stuff, I think, or maybe right after. But that's your swing short for the month of March. And that kind of happened again. What do we do now? You know what? I don't know, because it's not really working out that amazing. And if it bounces here, which it looks like it's trying to do, it's not like some random place. Like, why not the double bottom? Well, it's bouncing at the pivot. So if we bounce at the pivot, there's nothing directional for me to kind of give you any hardcore sort of advice, right? So that means we just go from top to bottom, bottom to top. That's too high. You can see this is the M3, and this is the M2, and we're just stuck in this sideways action, and that's not cool. But the tertiary move you might be looking for, let's see, blue, red, I guess I have to go yellow now, is maybe this if you're a bear. Okay. And that would be, again, risk on, dollar weakness, positive global macroeconomics and stuff. But bear in mind, oil is slightly topish. So if oil comes down, that's probably all commodities are coming down. That's probably a risk off. And you see dollar strength again. You see yen strength again. And we're a bit early. So remember, 3 weeks ago, I think it was. I think 3 weeks ago I said in the next 6 weeks, I'm going to look for the yen pairs to go up and macroeconomics to improve and commodity pairs to go up. Commodities to go up, I should say. Right? We're only week 3 in, and we still might be a week or two early. It's interesting, though, right, to talk about 6 weeks in advance? No, you're mixing two things up. You're mixing. So the question is, do you think Kudlow effect would cause USD strength because of perceived faster rate hike? You get very poor grades for that. You're mixing fiscal and monetary policy. So what you just said was gibberish. It doesn't make any sense. The Kudlow effect would be a fiscal policy that creates dollar strength. Monetary policy has to do with Jerome Powell, the FOMC, the Board of Governors, and more importantly, their open market operations that would lead to rate hikes, which could lead to dollar strength. Okay, yeah, so Kudlow effect is fiscal policy from the White House that creates dollar strength. Oh, yeah. And what Morgan Friedman, Morgan Friedman, what's this guy's name? Friedman. What the hell is his name? Not Morgan Friedman. Who am I thinking of? Milton Friedman. Milton Friedman. He would say this would lead to stagflation, where prices go up, but output would fall. So think of all the past examples of trade barriers. You had Soviets, you had communist Chinese, you had all of Latin America, you have Venezuela, which is South American, right? You know, all this kind of stuff. You start, like, give me a good example of trade barriers having a positive effect on a currency and an economy. And all of a sudden you're like, wait, none of those examples. You're like, well, there's Honduras, there's El Salvador, you're like, wait, those are not examples, good examples of trade barriers working. You're like, yeah, well, there's the Soviet Union. Yeah, wait, that collapsed and they're dirt poor. There's Cuba. There's communist China. There's North Korea has a closed economy. Right? Like, so there isn't an example of it being good. So yes, it could create inflation. Yes, it could lower output. Yeah, you got to help a brother out, Barry. So I don't know. It's an interesting place. Well, how could the Fed respond? Raise interest rates. And then the government's going to have to fund itself because the economy is going to slow. Yet its debts are going to be high. So this week alone, the United States government is borrowing $300 billion. Did you guys know that? This week. It's coming online. They're going to auction off these notes. $300 billion. Is it deficit? Well, it wouldn't all be deficit. Oh, is that right, Brooke? Cool. At least I know too, right? Which is, I suppose, important. So yeah, watch what happens. I think the 10-year T-note's going to tickle 3.0. We've been at 2.84 to 2.9. I guess between 2.8 and 2.9 for about 3 months. But what's going to happen to prices if 300 billion is being dumped onto the market in 1 week? I think prices might fall, therefore interest rates will rise. And why is that? Well, after selling 300 billion, there might be less buyers. So if the U.S. government is going to attract more buyers and new buyers next week and the week after, well, they'll have to entice them with higher interest rates, right? Because they already satisfied everybody at 2.4, 2.5, or sorry, 2.84, 2.85, 2.86. So let's say in a week or two, what are you going to have to pay to attract new investors? Well, we'll pay you 2.9, 2.92, right? Eventually, you're going to get up there. Now, Chuck says, does that mean the U.S. dollar goes up? Only if foreigners are buying. So Peter says longer-term problems. Well, why don't you look at the bid-to-offer ratio? Okay, so if we don't have a lot of buyers, then that's going to be a problem. The amount is not a problem per se, right? It's like what happens if we need to borrow money and there's no one going to lend it to us. That's going to be a bigger problem. Shaw says, why only foreigners are buying? That wouldn't be correct, Shaw. There are domestic and foreign buyers. So I said it depends on how many foreigners are buying the debt. Okay? Yeah. Cool. So anyways, I got to go, guys. So peace on earth. May the pips be with you. May your profits be above average. I'm going to upload this to YouTube right now. If you want to attend the YouTube live replay on the live stream, that's going to happen now. Make sure you give it a like. You should subscribe because you'll get an alert every time I make these uploads. You'll be able to access it from Forex.Today. It'll be up there just before 9 a.m. I don't know what time it is now. Ooh, it's almost 9 a.m. now. Oh my gosh. So it's going to take me about 10 minutes to get it up on Forex.Today, but then you can click through and attend a live chat on YouTube. You know, you go to the bottom right-hand corner, you click watch on YouTube, and then all of a sudden you're on the YouTube page. And then there's the live chat. So if you missed the first half or the second half or the third half of the webinar, you will be able to catch the live replay in the next, starting in about 10 minutes. And again, if you subscribe, you'll be notified as soon as it's live, and then you're easy peasy lemon squeezy. But it'll be available on Forex.Today in about 10 minutes. So peace on earth. May the pips be with you. May your profits be above average. Cheers.